Hello everyone. Thanks very much for coming to listen and for attending the presentation, and I hope you enjoy the event today. So my name is Dan Coatsworth. I'm the editor at SHARES magazine. I put a disclaimer because I know everyone loves one, but I won't read it because Emily's already done a good job. So really, when I look at a company with a view to writing an article, I try and think what the investors would be asking if they were the ones that were looking at it. So I read a lot of stuff on the internet, and it's full of investors who give the impression that they know what they're talking about, but perhaps they don't. But I think with a small bit of guidance about where to do the research, I believe a lot more retail investors can become informed and make the better investment decisions. So that's why I put together a guide, perhaps how to to research stocks, the theme of my presentation today. I've noticed that people are writing perhaps a bit differently about investments these days, and therefore investors are asking slightly different questions as well. Perhaps this is because the stock market has perhaps ground to a halt over the last few years. It's also down to investors getting better at spotting problems. If they know what to avoid, it helps to narrow down the investable universe. So the stereotype of investing, this man here. You buy whatever's in fashion. Tech in the 90s, mining in the noughties, anything that's a hot tip from your city mate in the pub. But I believe that the average investor could quickly become capable of making good decisions that don't conform to this stereotype. All it needs is a bit of common sense. So I find that most people's first experience investing is taking a wild guess, thinking that something sounds amazing will result in a guaranteed profit. So I know that the first investment I made was a stock called Subsea Resources. They found a sunken ship full of copper. They're going to dive to the bottom of the ocean and recover the metal. It sounded like something out of a Tintin book. How could I refuse? It was enough to make me hand over cash immediately. I thought at that time, wow, big investments is easy. Fortunately, I got a bit nervous when they had some bad news, and I managed to sell out roughly what I paid. I was quite lucky because actually Subsea eventually went bust. My late father-in-law, he was into funds. And one day he got some money and he said, I'm determined to increase my investment portfolio. He said, Jupiter, yeah, I see their adverts. Yeah, I've heard of that name. They must be good. I'll pick one of their funds. So any investor who's quite serious about what they're doing should know this is not how you pick investments. And I think my late father-in-law got lucky. The stock market was going up at the time, so he managed to make some money. But the same cannot be said for my dentist, who I constantly refer to in the magazine. I feel a bit sorry if he ever reads the articles, but he's the perfect person who's learned the hard way about why you shouldn't act on tips from your mates, why you should do investing before you buy, and why you should do research before you buy, and why you should do research after you buy. He had a tip from a mate. He said, you should buy this one, Beacon Hill Resources, coal miner, Mozambique, guaranteed to make you money. Each time I saw him, he was progressively downbeat. He was saying, but the coal price is falling, and then the company's taking longer than expected to do stuff. Money's getting tight. The next time I saw him, he said, my wife's banned me from investing. She's forced me to close down my share dealing account. I think I've lost all my money. His interest hasn't gone away in investing. So the last time I saw him, he said, I'm going to get back in. It's all right. I'm going to buy FTSE 100 stocks. They're all brilliant businesses, aren't they? They're all safe. They're big. But just look at the FTSE 100 performance in the last year. You know that's not quite true. It's actually some of the biggest corporate setbacks have been from companies in that index. So I'm hoping that my dentist will do some research before he starts buying again. And also, he'll think about that you just can't assume certain things and I'll assume that will make you money. So what should you do when you start to research? We are in an information overload. The internet is good and it's bad for investors. On one hand, it's great. Click on a website, get the financial results, get an annual report, presentations are there for you. But on the other hand, there's a lot of misinformation and companies spreading about bulletin boards and social media that just isn't true. I had a quick look on Twitter when I was putting this presentation together. I couldn't believe how easy it was to spot something. So this is one, Glenwick, G-Wick. So I don't know if you're familiar with this one. I think it used to be called Travario. It's a real estate company. Sold everything, became a cash shell, hired a couple of people who knew a bit about natural resources, and looks like he's going to make an investment in that space. But these are some of the comments on Twitter. Building a solid business. Why take 10% when you can have 100% or more in a week? It's going to multi-bag. This is a cash shell. It's got no assets. It's got no business. People making these statements are going to mislead people. I think people have got to be able to filter the bad from the good. By all means, listen to other people's opinions, but it's really important to form your own. To do that, start with reading the company announcements. These are available via the regulatory news service, RNS. Investigate. Here's a screenshot of their website. Go and look at there every day. All the good information is on that. Then find the company you like, go to its website and look for all the information there, and look for presentations under the investors section, because quite a lot of them have these days. This is Renew Holdings. This is a slide from one of its presentations, freely available to the public. It's got some brilliant stuff. Look, it tells you all about the trends for dividends, profit margins, revenue, earnings per share. These are really helpful for when you're trying to work out a long-term record. Is this company worth backing? Analyst research notes are really good for drilling down into a company's numbers. Unfortunately, they're not freely available to the general public. But Shares magazine, we do get them, and we try to highlight the best bits of research in the magazine. But even now, we're finding it harder to get stuff. Stockbrokers are pulling back from covering things that they can't get commission on. But there are bits of research that's commissioned by a PLC company. I'm sure you might have heard of names like Edison, Hardman, Progressive Equity. These are all free. It's easy to suggest they may be biased because they're being paid by the company to write the research notes, but they are worth reading. They can give really good, concise information that you might not get if you were just trying to look at a company's admission document. I say, dig deep into the financial accounts. Get in touch with the company if you've got any questions. Read everything you can. Let's get through that one. So really, we've got an example of an Edison research note I want to talk to you about. They don't have a buy and sell recommendation, but they're good for getting information. I remember seeing one on Silverdale. This is an asbestos removal company. It's no longer on the stock market. But I saw this note. I thought, well, Edison had been commissioned to write this, and yet they were flagging that the company desperately needed money for working capital in order to achieve its growth plans. I thought, that's a bit strange. You don't normally see things like that on Edison. I didn't see any of the other analysts looking at that, talking about this either. So I went to the company, I asked them all about it, and they went, no, we're fine, we've got all the money we need. But actually, it was true, because people started asking more questions about its working capital situation, and all the problems seemed to unravel after that. And again, the company went bust a few months later. And I think it'd be nice if house brokers could publish all the notes on their clients' public consumption. The forecast may be a bit over-generous, but there's always value in seeing a business dissected, which happens in much of these reports. Look at a PLC company's website, because some of them do give away their brokers' research for free. And also some of the stockbrokers as well. They've got it on their websites. Not all of them, but some of them do. If you're looking in the media, newspapers, they look at the big companies, but they don't really look at small businesses. They certainly don't really care about small companies' analysis unless there's a scandal attached to it. There's a few investment blogs which dig deeper. They get carried away sometimes, though. They don't really give a balanced view you get from a proper journalist. But I do read them, as occasionally there's a good source of accounting analysis. So really, as retail investors, you need to be able to look for clues and signs about the health of a company beyond simply reading the headline figures. How many times have you asked yourself, why is that share price falling? Or how many times you asked, wow, why is it rising? There's no news out. What's going on? To get these answers, you need to dig deep. Try and do a lot of research. At Shares magazine, we try and keep our readers one step ahead of the events. We look for great investment ideas, but we also inform readers about why share prices might be moving in a certain way. And I'll give you a couple of examples. of stocks where I believe that we were the first people to talk about the issues which subsequently hit the share price. It's important that you do your research, you can make an informed decision. So utility-wise, this is a classic example of a company why it pays not to just read headline bits from the RNS statement. 2 years ago, I wrote a story explaining that it had negative cash flow and contracts were being recognised oddly in the accounts. I explained the revenue recognition policy and why those earnings weren't converting into cash. The company was booking expected earnings as revenue, but payments were being staged over a number of years, hence there was a cash conversion issue. I said in 2014 the company was seeking to address this problem and had managed to improve some cash collection terms with its suppliers. But if you'd looked at the headline figures, you wouldn't have seen any problems. It was regularly reporting rising revenue, rising profit. It looked pretty good, but it's not that simple. In 2015, the share price started to experience big falls as investors and bloggers struggled to get their head around the accounts. Even one analyst was highlighting the revenue recognition policy as being a bit odd, and yet there was another fall in the share price. In December 2015, the company announced that it managed to improve supply terms again with a big client. The fact that it made that announcement showed it was concerned that people were picking up on some strange things in its accounts. But actually, if you read shares, you would have seen this 2 years ago, that there's cash flow risk. And you could have taken that decision to reassess the investment case. Some people don't like opaque accounts, and that could have been the trigger for you to think, well, do I want to still be in the stock? The other one that we've been looking at closely recently is Entertainment One. I published an article last month explaining why that share price had fallen by half, because the company certainly doesn't seem to want to tell investors what's going on. It's my role as a journalist to try and get the answers, but I also think as investors yourselves, you shouldn't be afraid to try and contact the companies to ask what's going on. This is another situation where on one hand it had customer payments that weren't coming in all at once. It was spending more money than it was making in cash. So there's cash outflow. You've got questions about why it decided to buy more off the rights to buy Peppa Pig. And then it raised more money it needed for that acquisition. And it refinanced a higher interest rate when it already had spare cash. It was just a succession of problems that people go, what is going on? Now, the E1 situation is very relevant to investors because companies sometimes find themselves that they can't give the explanation of what's going on. Their financial advisors and lawyers are telling them that they can't comment on things. This is not helpful for investors, but it does highlight why you need to do research. I'm not trying to sell copies of Shares magazine, but we would certainly look to do this, but you can go to many other places as well to find some of the answers. Now, I appreciate I've whizzed through quite a lot in this short session. Hopefully you should give you some ideas. But in a nutshell, I say never rely on the first paragraph of a results statement. Read it all. Always listen when someone's flagging something odd with the accounts. Always pay attention to the direction of a share price. Try and find out what's troubling the market if a share price is falling. And reassess the investment case if it still stacks up to your risk appetite. It's also worth doing the same if a share price rockets for no reason. If it looks too good to be true, you should think about what can it be to sustain that momentum. If you can't see a good reason, maybe that's your cue to think about taking profit. Make sure you've done your homework and research the stocks so you can make an informed decision. Thanks for listening.